Hello, everyone. Welcome. My name is Siwei Yi, and my special guest once again is Mr. Richard Akbani from Guarantee Rate Mortgage. How are you, Richard?
Doing well. How are you? It's been a little
Well,
while.
I know now, yeah, we are long overdue to discuss some very important matters in terms of the housing market with the interest rate, the housing market, all the changes. Without further ado, we can start off by going through the Mortgage News Daily. And the reason why I want to do this because it's all about interest rate mainly. Let me go through this past year, 2022, and the first quarter 2022, everything's coming along quite nicely. As you can see, the 30-year mortgage rate has been doing well. Less than 4% rate. Housing market is going very, very strong. Skyrocketing housing prices, huge historic low inventory. So a lot of bidding wars and multiple offers during the first quarter of 2022. Then all of a sudden, Federal Reserve crashed the market. And as you can see, you see the trend around May or June timeframe. We start to see the tremendous downturn in the interest rate, tremendous decrease. As you can see, uh, June to 5.8, then July 5.7 mortgage rate. Then you see the tremendous decrease in demand. People just getting a great shock that caused a first psychological scar among many realistic people. So then let me fast forward. See the trend kept going up in August and September, and then all the way up to the highest around 7.32 on October 22nd. Now this is the crashing moment. I mean, this is where everybody's just panicking.
It's important for everyone to note as well. These are primary home interest rates that you're showing, right? Interest rates obviously were
Yeah.
dramatically higher.
Yeah, and the investors, of course, is probably it's a 50% basis point higher investment mortgage rates. Then the rate has gradually gone down from October in November the 30th back down to 6.6, then back to December 6.3, and then the good news is that look at this. Then we are moving into the beginning of the year in January. In fact, starting in January, the rate was 6.1, which is amazing. Then there's a lot of positive signs of everybody getting excited, including myself. Then down here, February the 1st, around a couple of weeks ago, the mortgage rate for people with good credit, primary home buyers, owner occupied, is in fact is 5.99%. When I saw that a couple of weeks ago, 5.99%, I said to myself, wow, this is really trending well. I'm more excited, and people, my colleagues, or everybody's excited. My investors are excited. Everything else, and then, people, all kinds of news media. They made a lot of 2023 realistic forecasts, and they are saying the mortgage rate are turning down. This and that. So a lot of positive reinforcement the past few months. Then, before you know it, the volatility then before you know it, as we speak, a couple of days ago, the mortgage rate, according to Mortgage News Daily, look at the current mortgage rate. 30-year fixed rate mortgage is 6.5%. In a matter of few days, the mortgage rate jumped so significantly higher to 6.5%. So that really create a lot of confusion and a lot of optimistic to yeah, pessimistic point of view. So with that said, what is your take on it? Since you are in the mortgage industry, this is what you do every day. You watch the interest rate, you watch the 10-year treasury, you watch the inflation rate, you watch Jerome Powell and Federal Reserve, what they're thinking. And oh, by the way, we're going to have a CPI consumer price report coming up February 14th, I believe next week. That's another important event. Then we have a job report that it feels so strange. With a job report uh, is very, very positive. Yeah, we have with an increase of like half a million jobs that came out a few days ago. That probably caused the mortgage rate to increase, in my opinion. Okay, enough said. What's your takeaway from what's going on of all the mortgage forecasts, all the projections, all the positive reinforcement we have up until a few days ago from 5.99, we thought we have reached the 6%. When I said to myself a few months ago, when mortgage rate reached a threshold of 6% or less, it just created a whole bunch of psychological optimism out there for a lot of people. Now, I mean, now let's go back to a depressing mode, back up to 6.5%. Well, no, so what's going on? I know you don't have a crystal ball, but what the heck is going on? So take it away, Richard.
You did a good job, obviously, of sharing what's happened in the last 12 to 14 months. The good news is mortgage rates are off the highs, as you alluded to. They're up from the recent lows we experienced, but overall, I mean, they're down about 1% from the highs we hit as investors. Now, it's interesting because for the average property that a lot of us are looking at, that 1% reduction in rate is 150 to $180 a month, based on depending on your loan amount. And that 150 to $180 a month is cash flow that wasn't there at all 6 months ago when rates were higher. It was very difficult to find a property that would cash flow. And this reduction in rates paired with, the builders getting aggressive and incentives and all that, I think we're in a very unique buying opportunity as investors to where, we have access to inventory that didn't exist before. Most of us know that are actively buying homes. A year ago, you couldn't sign a contract on a construction home for even 12 months out, right? You were buying things 1 year, 2 years, sometimes even 3 years out. And in addition to that, a lot of the big home builders and even markets that we work with really didn't sell to investors, right? There's such a big housing shortage, and the towns, the municipalities issue permits to these builders, and they were putting a lot of pressures on the builders too. That hey, we have local populace that needs housing. These need to be dedicated to primary home buyers. And now what's happened is we're seeing inventory open up in these predominantly owner-occupied neighborhoods that investors can never get into at all, which is huge. So once again, we're in a very unique buying opportunity. We look back to COVID, everyone thought real estate was going to crash after COVID. And what happened, right? Nationally, prices rallied 30 to 35%. Rents went up, same 40%. And the people that took action and that headed towards the perceived danger versus, the herd of everyone else running the opposite direction did very, very, very well. And given that we're all investing for the long term, I think now's an amazing time to real estate because you have less competition. Once again, there's builder incentives, there's inventory that didn't exist, and rates have come off their highs as well. But the most important thing, as you said in one of your videos, we're dating the interest rate. We're married to the property. So, let's not make a decision today that, the rate's too high to buy a rental. Well, the variable that you're making that decision on not to buy a rental is just the interest rate. But this is a long-term investment. That's not a fixed variable. But if you look at all the other variables, supply, demand, ability, builder incentive, they're all saying buy, buy, buy. So I think we need to get away from the variable to the constants, which all, really say, hey, this is a good market, I think, for us as investors to buy. And then look, if I buy a new construction property at 250 today and it drops to 230 next year, right, which is 10% reduction, who cares? I don't care. I'm not trying to sell it. I'm buying it for 10 years. Guess what? Come back up to what I bought it for. It's going to go back even higher, and what if rents went down, $150 a month, which would be 10% from where they are. Okay, well, now my properties break even. My only return is the tax savings, the return on amortization, because the tenant's still paying my balance down, right? It's still a long-term wealth building vehicle like I bought it for. So, once again, I think the potential negative downside, look, we don't know what's going to happen. And they keep saying we're in a recession. The Fed's doing their best, the hardest they can to push us into this big recession. And they can't do it. Like you said, the jobs are still there. Real estate was so robust. And they even said it early on. The inflation side, real estate, we need to slow real estate down, right? And then hike rates through the triple interest rate. But guess what? Real estate's still robust right now. And why? right? It's a combination of things. One, the main thing that caused real estate to be so robust, supply and demand, hasn't changed, right? That's the external influence, artificially raising rates, but the supply and demand issue has changed. Another thing too is, and a lot of you will relate to this out there, for 70% of the people or 80% of people that own a home, and you're at 3% or 2.8 on your interest rate, you're not selling, right? So whoever has homes, they're not selling. We're holding on to them. So there's extremely low. It's kind of backfired on the Fed, right? There's extremely low availability of homes. There's no one selling. There's not new homes coming on the market. And and they're furthering the supply and demand problem. So instead of everything crashing, things are leveling out. And, it's easy to look at and I know I'm going on almost a tangent, a rant here, but, it's frustrating because you look at the headline, prices drop. And, then you read the article and it's like, well, the values are still higher than they were 2 years ago, or even 1 year ago in a lot of situations. But, the projected numbers are lower than, where they are. And yeah, builders are incentivizing properties and bringing things down, but they're bringing it down from the projected highs. The bringing down is still in line with where it was a year and a half ago, prior to COVID. So
Yeah. Yeah, Richard, you have made some amazing recap, and I wholeheartedly agree with you.